Hey everybody, Bill Faith here from Build Short-Term Rental Wealth. Hope you guys are having an amazing day. Sorry, just had a couple of technical issues, so we're running just a couple of minutes behind today, but I promise you we'll make up for it with our special guests that we have here today. Very privileged to have two of the absolute experts in the tax side of short-term rentals that are going to be joining us. We're going to be talking about how you can save 5 to 6 figures by using some loopholes in the tax code. These guys are so gracious, and they're just, I was on their podcast a few weeks ago, and it was just, we didn't really know each other before that, and it was just mind-blowing, kind of the rapport, but they kind of fall into my bucket, and they're givers, right? And that's something that I love. They have put together probably a $2,000 or $3,000 tax course right up here above me. If you see inside of it, you can use my code STR Wealth. Check it out and get $50 off. It's like a $2,000 or $3,000 course. It's $247. Use my code STR Wealth, and literally you're going to get it for $197. That's like the best investment you've made in a long time. I know I spent that on dinner in North Carolina last week. I wish I would have saved it. That way I could buy the course and probably save thousands. So without further ado, let's jump in. I'm going to introduce Brandon Hall and Thomas Costelli from Hall CPAs. How are you guys today?
Doing well. Thanks for having us on.
So, I just want to get started right off the bat. You know, you guys probably recognize when I was on your guys' podcast, I just want to get straight to the important shit. So how do I save 5 to 6 figures off of what is this loophole that we're talking about, kind of in your course that I just promoted for you guys?
Go ahead, Tom.
Yeah, so kind of long story short, all rental activities are passive under the tax code. So that means you can't use the losses from your rental properties against your W-2 or active business income. However, there's a special carve-out specifically for short-term rentals. And that carve-out is, and there's a little bit more that goes into it, but it's 7 days or less, right? If you have an average customer stay of 7 days or less on your property, then you're accepted from the definition of a quote-unquote rental activity. And what this means is now you have a regular business. And if you start to materially participate, in other words, you self-manage your properties, then you're going to be able to take the losses from your short-term rentals against your active or non-passive income, as they call it, and significantly reduce your tax bills. And it's quite amazing that this is in place.
Okay, so I'd like to kind of lead in with that really juicy type of stuff. And now I'm going to get to the really important stuff. Look, you guys are sitting there in t-shirts like myself. You don't look like CPAs. You're sitting in your home, whatever. We're used to seeing this button-up 3-piece suit. Why don't you start? And I want to start with you, Brandon. And I know you guys have like huge backgrounds at like PwC and that type of stuff. So introduce yourselves to everybody, because I didn't want to do you guys a disservice here.
Sure, yeah. So my name is Brandon Hall. I started the firm, Hall CPA, back in, I believe it was like the end of 2015. But I was still working at the Big Four. So I did some time at the Big Four accounting firms and started this firm like kind of on the side. Went full time in 2016, September of 2016, I believe. And then I was on the Bigger Pockets podcast. And that's kind of what started blowing it up for us. Yeah.
Just everything, right?
Yeah. It was great. Really great. And so it just kind of scaled it out from there. But my vision for an accounting firm was never to be like a tax prep shop. It was always to be an advisor. So I always had some sort of advisory component to being a client here at the firm. Like you couldn't just get tax preparation. And that has changed significantly over time, like what we do advisory wise. But now we've got a pretty darn good system that delivers really good results for our clients. But yeah, we work with real estate investors all over the country, big and small. We're rolling out a CFO service line for relatively large investors, commercial property owners, large portfolio owners, to kind of get clearer financials and everything like that. So really just kind of being ingrained even further into the real estate industry as a whole. But we've got a team of 40 folks here at the firm. Tom's a partner at the firm, and Tom has been running our information side of the business, because what happens at our firm, I built the entire firm off content, just posting things on Bigger Pockets, writing blogs, doing the podcast. And we get like 250 or so people that fill out our web form every month. And, the reality is that we price our services a little bit higher than most firms, and we're okay with that. But we want to help all landlords, and that's the problem. That's my personal problem, is I want to help everybody, even if you can't afford our services. And that's what kind of gave us this idea of, could we roll a course out, not in like a guru fashion type way, but something that actually helps people, ask their CPAs better questions. Like, there's key things that we see missing in like almost every tax return that we review when somebody tries to join our firm.
Well,
So we
I
just
don't mean
kind
to
of,
interrupt you, but Thomas mentioned
yeah,
the term material participation.
yeah,
And like most of the STR people, or a lot of them are coming out of the LTR world, right? And
yeah,
we hear the term real estate professional, and like Ryan Pineda is dropping that like every hour on,
yeah,
Instagram all day long, right? So just knowing the difference, because like most CPAs don't even know the difference between LTR or commercial, industrial, and short term, or the difference
yeah.
between material participation and being a real estate professional, right?
Oh yeah, no, we know, and because we've had conversations, because we'll talk about this, and CPAs will say that's wrong, and then we'll give them the Treasury regulation and the tax court cases. Then they go, "Wow, I never knew that this existed. This is really cool." So yeah, I think a lot of people, real estate professional status is like the cool marketing, like, hey, I can save you a crap ton of money if you qualify as a real estate professional. But the reality is that the vast majority of landlords don't qualify as real estate professionals, because they're working full-time jobs. You can't qualify as a real estate professional if you work a full-time job. I don't care who tells you that you can; they're wrong. And so short-term rentals, like Tom was explaining, you don't have to be a real estate professional to claim the losses from a short-term rental activity, because a short-term rental is not considered, it doesn't meet the definition of a rental activity under Section 469. And Section 469 says all rental activities are passive unless you qualify as a real estate professional. So if I don't have a rental activity, I don't need to be a real estate professional.
That's awesome stuff already. I'm going to give you the first question, then we'll drop down to you and introduce Tom. I'm sitting here in my lake prep property filming this podcast right now. Does that qualify for material participation hours?
I think the IRS would say no. You have to be like working on the property, maintenance, repairs, managing it, something to that degree. What do you think, Tom?
I think I've got a hammer in this drawer right over here I can grab. And
Just
so, I
passively
mean,
hammer,
and
you're
that
like,
becomes
"Let's go."
super important, right? So a lot of people that come to my stuff, and I'm sure that you're going to have live events, or if they're going through your course, and I knew the answer to that, but that, like, the education doesn't qualify, right? Like,
Right.
literally have to be cleaning, maintenance, physically working on the property.
Yep.
Right.
So listing optimization, marketing, that type of stuff does not count, correct?
I would say it does.
I would say it does. Yeah.
Okay.
Yeah, because
Awesome.
that's working on the property. You're trying to get tenants in the door. It's a leasing activity, right? So leasing activities are going to count as material participation. Now, we've had clients say, "Oh, it took me 8 hours to set up VRBO," and frankly, before I had my own short term rentals, I was like, okay, maybe. But now that I have my own short term rentals, I'm like, dude, it did not take you 8 hours to set it up on VRBO, and if it did, then you need some help, because it's way too long.
Right.
You
Now,
take the
maybe setting
picture.
up owner res to integrate might take 8
Yeah.
hours plus, but
Yeah.
VRBO probably not.
Yeah, exactly. Yeah. So if you're set up the entire suite, all the automations, okay. But how much does it actually take to put some copy onto VRBO, put some pictures up? It's probably not. I mean, I'll give you an hour or two, but 8, it's a long time.
I mean, I'd say I probably take 2 to 2.5 hours on average to set up the first one. Then it's basically copy and paste between Airbnb and Verbo.
Right.
All right, Thomas, sorry to keep you waiting in the wings, my friend.
No problem.
Thomas
No problem.
Castelli, very similar background. I can't remember. I didn't want to I saw Ernst & Young. I saw PwC. I couldn't remember who was where. I mean, just to legitimize everything before you come to this standpoint. Thomas, give us your 30-second intro.
Yeah, absolutely. So I started off at a firm, BDO, which isn't the Big Four, but it's like kind of it's right below the Big Four. And I started out there, and I kind of realized that big corporate doing corporate audits wasn't really my thing. So instead, I was going to go into real estate. So I had a big passion for real estate. Had ended up doing a deal as a general partner in a syndicate, an 82 in an apartment complex in Jacksonville, back in 2017, right around the same time I met Brandon. And joined the team here, became a tax strategist, and been helping people reduce their taxes. It's been an honor. I've been able to work with I always say 100 plus, but it's really closer to 200 to 300 clients when I go back and look at it, helping them reduce their tax bills. So that's what I've been focusing on here now. I have an advisory team that helps people reduce their tax bills, and that's kind of the Cliff Notes version of my story.
That's awesome. Well, I'm really excited for you guys to be here. Just FYI, I usually plan on these things to be like 30, 45 minutes, but there's no question we can go a couple hours if you guys have time, because I know the questions are going to start flowing in. Those of you that are at home or on, one of these little things right here watching, please say hello and let me know where you're from. This is also a live broadcast. The purpose of this is to ask Brandon and Thomas questions. I've only got 3. I got 2 to get to over here already in the comments. So this is all about you. You're essentially getting free tax advice right now, so take advantage. I'm just going to start with the 2 questions, if you guys don't mind. Does bookkeeping count as material participation?
It depends. So if you're self-managing your property, right? So meaning you don't have a property manager and you're involved in the day-to-day operations, things like bookkeeping will count as material participation. Now, if you do have a property manager and you're not involved in the day-to-day operations, then typically, the IRS and tax courts are going to disallow time spent keeping financial records, because they're going to look at it as an investor level activity and not as a managerial activity. So in order for that time to count, the bottom line is you have to pretty much be self-managing properties and being involved in the day-to-day operations.
And really, that kind of flows in your answer, Thomas, into this question. If you have a full-time W-2, you can qualify for material participation. It's going to be challenging, but really it's when you hire a property manager or a co-host that's almost going to exclude you from being able to do that, because it's not only, and I ask this as a rhetorical question, not only do you have to meet the 100 hours, but you also have to be the person that spends the most time on the property. Is that accurate?
Well, let's talk about so what I was talking about was real estate professional status. To qualify as a real estate professional, you have to spend 750 hours in a real property trade or business and more time in real property trades or businesses than you do anywhere else. So if you work a full-time job, you will not be able to substantiate that you are a real estate professional.
Gotcha.
Short-term rentals, you can materially participate in a short-term rental, and you can do that with a full-time job. The reason that you can do that is you don't have to qualify as a real estate professional on your short-term rentals, because a short-term rental is not a rental activity under Section 469. And all rental activities are passive unless you qualify as a real estate professional. So if I don't have a rental activity, then I don't have to worry about qualifying as a real estate professional. So the key to understand is that the real estate professional status, if you work a full-time job, you cannot qualify as a real estate professional because you must spend more time in real estate than anywhere else. But short-term rentals don't have to worry about that rule, because short-term rentals are not rental activities. So I can materially participate in my short-term rentals, but I'm not going to qualify. If I have long-term rentals, they're all going to be passive because I can't qualify as a real estate professional when I work a full-time job. And we have a whole bunch of tax court cases on this. I know that this is an area where CPAs do say, oh, yeah, you can be a real estate professional because you have a big portfolio, even though you have a full-time job. It doesn't matter how big or small your portfolio is. All that matters is, did you spend more time in real estate than you did anywhere else? The IRS is never going to believe you that you spent more time in real estate than you did anywhere else. And we have in this training, maybe not the short-term rental training, but we've got another training where we do list all the tax court cases. We've got a free guide on our website that lists all the tax court cases that prove you're not going to qualify as a real estate professional, because we give you that information so that you can kind of like see who to trust when you're hearing that advice from your CPA. But in terms of short-term rentals, you're good because you don't have to qualify as a real estate professional on your short-term rentals to take those tax losses.
But they still have to have 100 hours if they have one property, correct? Minimum. And they have to be the maximum. They have to be the person that puts in the maximum amount of time. So they have to outperform their cleaners, correct?
Yes. Yeah. There's 7 tests for material participation. You only need to meet one of them. You just described the 100 hours and more than anyone else test. So yeah. So if Bill, if you and I are partners and you work 101 hours, then I need to work 102 hours, right? So I need to outwork you and spend at least 100 hours. Or if Tom's my cleaner, sorry, Tom, I know that you know.
I get the clean.
Tom's my cleaner, I got to outwork Tom. And if I can't do that, then I've got to hit 500 hours. That's another test for material participation. So,
yeah.
I think we might have lost Bill.
Bill looks like he's frozen.
It's okay. We can keep going because we can see the comments, right?
Right, can we? I have to exit
Yeah.
this out.
Yeah. StreamYard is just like click over the
Oh wow.
comments.
Oh, this is cool. This is cool. All right.
One person said, appreciate that. Would love to have Ryan on to discuss with you as a follow-up. Yeah, we actually interact with Ryan a lot. So can you guys still all see us? Can somebody just like throw in, I don't know if Bill hosting, if we just lost. Okay, well, we can still see the comments coming in, so I assume that we're still live. So let's just keep going. Look, we podcast all the time. We've got all this stuff, so we can just start taking the comments. I don't think that I can show them on the screen like Bill could, but that's okay. So yeah, so Ryan Bake, love that guy. We like the three of us, him, me, and Tom, talk relatively consistently. He's probably one of the more consistent CPAs that does not work in our firm that we talk with on a consistent basis.
Right.
But he's in alignment with everything that we say and do. And then somebody asked, I'm a real estate agent. Ooh, this is a good one, Tom. I'll let you take this one. I'm a real estate agent. Does that automatically make me a real estate professional for short-term rentals? So let's talk about, does being a real estate agent qualify you as a real estate professional? And maybe just repeat the whole real estate professional versus short-term rentals, because it's not working from what I've said.
Yeah, absolutely. So if you're a real estate agent, what's going to end up happening is you're going to probably qualify as a real estate professional if you're working on a 1099 basis. So if you receive a 1099 from your firm, you're an independent contractor, then you're probably a real estate professional. Now, real estate professional, that's for long-term rentals, all right? Long-term rentals, if you qualify as a real estate professional and materially participate in your long-term rental activities, you're going to take losses from those properties against your W-2 income or your active income. Whereas short-term rentals are accepted from rental activities. So qualifying as a real estate professional, regardless of whether you're an agent or not, is not going to allow you to take losses from your short-term rentals. In order to take losses from your short-term rentals, you need to meet one of the exceptions under the short-term rental loophole, and then meet one of the material participation tests, which again, it's either you're going to do everything. So one of the tests, there's 3 tests that really most people are going to really need to know. It's either you do everything yourself, basically you spend 100 hours and no one else spends more than you, or you spend 500 hours in the activity. You do one of those 3 things and you're going to be able to take the losses from your short-term rentals.
Yeah. The key with the short-term rentals is that it's not considered a rental activity under the Internal Revenue Code. And only real estate professional status only applies to rental activity. So a rental activity would be like a commercial office that I own. It'd be multifamily that I own. That's like a long-term rental. So short-term rentals are not considered rental activities. I know it sounds weird, but we got to think about the Internal Revenue Code versus like reality. So the Internal Revenue Code says a short-term rental is not a rental activity, and only rental activities apply for real estate professional status. Now, I did want to follow up on I'm a real estate agent. Does that qualify me as a real estate professional? So I want to clarify that. Getting your license to be a real estate agent does not automatically make you a real estate professional. So again, I'll repeat the qualifications to be a real estate professional. You have to spend 750 hours in a real property trader business. One of those real property trader businesses is brokerage. So having a real estate license allows you to participate, but you still got to spend 750 hours in a real property trader business, and you have to spend more time in those real property trader businesses. You can combine them, but real property trader businesses than you do anywhere else. So if I'm a real estate agent and I spent 800 hours being a real estate agent, but I'm also like, I don't know, an IT contractor or a software developer or a doctor, and I spent 1,800 hours doing that, I'm not a real estate professional because I spent 1,800 hours in a non-real property trader business, and that was more than the time that I spent in the real property trader businesses. So your real property trader businesses have to exceed the time spent anywhere else. And this is really beneficial for people that have long-term rentals. So if I buy a 30-unit apartment complex for $5 million and I want to cost segregate it to get $1 million of tax losses in the year of acquisition, qualifying as a real estate professional will be very important to that strategy, right? But if I'm buying a short-term rental, I don't need to worry about real estate professional status. I just need to worry about materially participating in the short-term rental activity. So I hope that kind of helps there. I'm going to move to Philip outside of Atlanta. If someone wants to start working with Brandon and Thomas, what does that look like? Is it only tax strategy, or do they offer bookkeeping and tax prep as well? So we offer all of it. We offer tax planning, preparation, and bookkeeping. But our bookkeeping services are kind of like, you're probably looking at, you need higher property values, or you need a few properties to make it worthwhile for us, because we do a lot more than bookkeeping. Like, we're going to help you understand your portfolio, understand your performance, and make better financial decisions. Like, our goal is to help you improve your profits. So we're not just going to be like, if you're just looking for somebody to book transactions, probably not the best use of your money to come work with us on the bookkeeping side. So we can advise you all day long with our advisory stuff.
So sorry to leave you guys alone there.
No worries. We just started riffing. We've got all the comments.
Yeah.
So
awesome. All right. I'm going to back out. I'm going to go work on my book. You guys have a great time.
There you go.
Like the worst timing ever.
It's all good. We were down to what activities classify as material participation for 100 hours. Actually, I don't even know if you could see that, Bill, but we could hit that question and then move to whatever other questions.
Yeah, that sounds great. Hit it. I love it.
I think that's a really good question.
I think that's a big challenge, is people get confused, and you probably address this between STR material participation and professional real estate status.
Yeah.
Hit it.
Yeah. Can you repeat the question real quick, Brandon? Sorry.
What activities classify as material participation for the 100 hours?
Right. What activities qualify? All right. So when we're talking about short-term rentals specifically, it's going to be things like listing your property on VRBO or Airbnb, taking photos. Now, you have to be realistic with the time you spend here, like we talked about before. You can't be excessive, but that time is going to count. The time spent interacting with potential guests. So if you haven't automated that yet, you're still talking to them, that time is going to count. The time spent coordinating with cleaners and handymen and those type of people going to perform repairs on your properties. Actually going to your property and doing the repairs, maintenance, and capital improvements yourself, that time is definitely going to count. So that's kind of in a nutshell what time is going to count. Now, that's where you're going to want to spend a bulk of your time. Stuff that's actually going to be hands-on operational with the property. You don't want to be spending time trying to claim time like education, like we mentioned before, or traveling to the property. A lot of people ask the question, does travel time count? Oh, I live here in New York. So people are like, oh, my short-term rental is located upstate New York. It's going to take me 2 or 3 hours to drive up there. Does that time count? Fortunately, it does not count. It does not count. Travel time from your home office or from your actual office to the property does not count. There's the IRS basically confirms that, and then we have additional tax court cases that continue to confirm that travel time generally does not count. So
what about travel time from your STR to Home Depot and back when you're actually on site?
That's like local transportation. That's fine in most cases, but it just can't be like an excessive trip. So what happens is people get confused with the travel, because you could have a legitimate business expense. Like, that travel, it could be a business expense. The writing off the mileage to and from my home on this 2-hour trip, or if I'm booking a plane ticket and I'm going down there to work on my short-term rentals, that's very likely a business expense, but not going to count for material participation, because you're not actively swinging the hammer. You're not doing something that the property manager would necessarily do. And that time's just not going to count for material participation. In the tax court case, I believe it came out into 2020, was Lucero versus Commissioner, that just reconfirms that for everybody, because that's always something that people are like, oh, well, one CPA told me it counts, and then we just show you 3 tax court cases that say that they don't. But that's where you get the list of the activities that count and don't count, is by actually reading the tax court cases, and we break them down for folks on a lot of the content that we produce. So, we give you the actual citations.
Yeah. I mean, in the course,
glossing over a lot here is what I'm trying to say, but
no, in the course, I have a module in the course that breaks down relevant tax court cases for short-term rentals, and it really clarifies a lot of things in those tax court cases. So,
and those of you that are just joining, if you look above us in the post, there's a link to the course, and if you use the code that Brandon and Thomas have so graciously given to me, STR Wealth, you can save $50. So literally, you're in for like $197. Just the last 45 seconds of what they've explained, just learning that is worth 10 times the $197 for this course.
Yeah, and to make it better, if you already own short-term rentals, it's going to be tax deductible. So there you have it.
Yeah, there you go.
Nice.
Yeah, now it's only $100, $120. There is a question on here that I would love to answer, Bill, if that's okay.
I mean, if you're just going to fucking moderate, I'm heading out to the lake. I'm going to go jump on.
I don't want to go, man. Your group
I'm going to be out of a job real quick. Jonas, you jump in here. You can handle the cost save questions I got. You can be with Thomas and Brad, and I'm out. No, go right ahead. Absolutely.
All right. I'll do this one, and then I'll pass the mic back.
No, I'm just messing with you. You know.
So we had two people ask the same question. Really good question. Can I combine time with my spouse for material participation purposes? Really great question. So I want to clarify. I'm gonna talk about real estate professional status and then material participation. And the reason I want to do that is to draw a very clear line between the two. Real estate professional status, again, not for short-term rentals, but I need you to understand real estate professional status because so many tax advisors mess this up. They think that short-term rentals and real estate professional status is all synonymous. It's not. Real estate professional status, only long-term rentals, material participation, short-term rentals, and long-term rentals, but for this case, short-term rentals. So material participation or real estate professional status, 750 hours, more time in real estate than anywhere else. I have to achieve that on my own. So for my long-term rentals, I have to qualify as a real estate professional by myself. But for the purposes of material participation, I can combine my time with my spouse. So for the purposes of this podcast, for short-term rentals, if I spend 100 hours doing repairs and maintenance, and then my wife spends 50 hours setting it up. Don't record 50 hours setting your property up on VRBO, but let's just assume that that's what it was. Then combined, we have 150 hours for material participation purposes. So you can combine your time with your spouse for material participation purposes. But I want to make it very, very clear that if you are separately qualifying as a real estate professional, that has to be done completely on your own. You cannot combine time with your spouse for that.
So time can be combined to qualify for material participation on the STR side, not on the real estate professional side.
Well, this is where we get kind of into the weeds. Time can be combined for material participation purposes. If I qualify as a real estate professional in my long-term rentals, that's step one. Step two is also showing that I materially participated in my long-term rentals. So the same rules apply. And for the material participation purposes, I can combine time. And where this gets where this will start to make sense is, let's say that my spouse is a real estate agent and she spends 1,500 hours a year being a real estate agent, and it's all she does. She'll meet the 750 hour test, and she'll spend more time in a real property trader business than anywhere else. So she is a real estate professional. She met that by herself. But let's say that she hates dealing with the rentals. She doesn't want to touch them. She spends zero time touching them. I can do the material participation for our long-term rentals at that point, even though I'm not the real estate professional. So that's kind of where the caveat is. But for short-term rentals, all I have to worry about is material participation, and we can combine our time for material participation purposes.
And you have to qualify each year, correct? It's not do it year one and then it carries over into 2, 3, 4, and 5.
Yes, and there's no like a question we sometimes get is, well, it's 100 hours for the entire year, but if I launch my short-term rental in December, do I only have to do like 20 hours or 10 hours or whatever? And no, you still have to do the full 100. So there's no proration of hours.
So that becomes really important if you guys follow me and what I do for my tax strategies at the end of the year. I can't literally put a property into service on December 26th and have two-night stays and think that I'm going to qualify, unless I've been doing 100 hours worth of, work leading up to that, right? So that's the next question that I think becomes confusing to people. Do the hours put in prior to taking the property live, making it available to qualify, if they're rehabbing, if they're furnishing, if they're designing in their setup phase, does that count?
Yeah. So generally that time is going to count. So, the time you spend rehabbing the property, getting it rent ready prior to renting it out will typically count towards your real estate professional status or your material participation on your long-term rentals. Or if it's short-term rentals, your material participation for your short-term rentals. And that's because you own the property. You now have the activity, you're putting in work on it, and that's why it counts.
I want to go back to the question about local transportation. And I, like everything else, I assume it has to be in reason, but I just want to use an example. Literally last week, so there's a low, I have 2 properties in the northwestern North Carolina mountains, and this is a real use case for me. There's a Lowe's 20 minutes away. Lowe's did not have what I needed. I needed to literally go buy an air conditioner. I had to drive to Johnson City, Tennessee, which is the next closest place that had it, which is literally an hour and 20 minutes each way. So I have 2.5 hours of drive time, let's say 30 minutes, 20 minutes. And so like roughly 3 hours round trip for the whole purpose. Is that legit to write that off or to use that for my material? I mean, I don't need it, but I'm just saying if I needed to use that to qualify, or is that too excessive?
I would say yes. I mean, yeah, I would say yes because you would be doing what any repair person would be doing at that point, right? We don't have the part here, but I need to get it done, so now I've got to drive extra to get it done. That's that substantiation, which makes total sense. What the IRS routinely disallows is just I have a short-term rental that's 3 hours away, and I go visit it 5 to 7 times a year to do repairs. It's like that me visiting that property, doing that travel, it's not pertinent to the ongoing operations of that rental because I'm only visiting it a handful of times a year. Now, if I'm, sometimes we even get the question, well, what if I drive out there every week and stay out there and come back? Well, that's something that hasn't been litigated yet. We haven't seen that pop up in the tax court yet. But in theory, it's like, well, if I'm out there every single week running this thing, then maybe that time does count. So it's really just like when I'm visiting the property infrequently, when it's multiple hours away, the argument is you don't actually need to be there. You don't need to be doing this trip to make the property operate on an ongoing basis. Otherwise, you wouldn't have any success that you have. So,
gotcha. I'm going to use this question kind of just as a seed for how much granularity do we really need to have when we're tracking, in a Google sheet or a spreadsheet or, Rev Tracker or any of the apps that we're using.
Yes. Go ahead.
No, I was going to say, so we get this type of question all the time. Like, how granular do you need to get with your time tracking? Like, look, you want to, everything, the key word here is reasonable, right? Because the IRS wants to see that you're reasonable and a credible, like, witness, for lack of a better term. So you should track that time. Now, I generally recommend tracking in like 5-minute increments, 5 or 6 minute increments, because that's typically what lawyers and accountants do. But as long as you have the time down, you could substantiate, like you have the log, right? So for example, you have the text message log, and you could substantiate that under audit. I think if you're tracking your time reasonably, you're going to be putting yourself in good shape.
I'll also add that so in the Lucero versus Commissioner tax court case that came out in September 2020. There was a write-up. So in these tax court cases, the judges are going to like write up their opinions and everything. And part of that, they said, because Lucero basically said, I spent 100 hours and more than anyone else. But what they said in the opinion was, but Lucero furnished no documentation to essentially show what anyone else worked. With the implication kind of being, if you can't document your cleaner's time, your repairman's time, your property manager's time, then how could you possibly say that you spent 100 hours and more than them if you didn't document their time? So kind of something to think about if you want to bulletproof your position. Then you also need a ring camera or something, and you're notating when my cleaners enter when my cleaners enter my property, when they leave, and you're logging their time as well. But to echo what Tom said, you do need some sort of time log. You can use Excel. You can use one of the time tracking apps out there. We have a little potential surprise coming in the next couple months for folks as well. But yeah, you need something that will bulletproof everything for you, so that, because that's going to be the first thing that the IRS asks for when you're under audit for something like this. They're going to want to see that time log, and you're going to need to be able to send them something that's already filled out, nice and substantial. The more that it's filled out, the less questions you're going to be asked, the less digging that's going to happen.
So what I'm hearing you say is, this house I'm in, this is a lake property that I own, an STR. I'm down here working. I got to do some repairs later this afternoon. Is I shouldn't really just cost average. I know that it takes an average of about 3.5 hours for my cleaning crew with 3 people to clean this house. And I've got ring cameras. I literally need to probably weekly or daily or every turn go in and update time in, time out. And the number of cleaners, do I need to be that granular, or can I cost average that?
That's a good question. So there's not that much support we have on this from a tax court case to be able to give you like a definitive bulletproof answer. Like here's what's going to come down to. Again, is the time log you have reasonable and credible? If you can reasonably ascertain that, that the cleaners come in and spend 3.5 hours, right, on average, and go ahead and put that in the time log, because you know why? Because you could always go back and substantiate that with the ring recordings if you ever need to. Now, do you need to take the time every single week to go ahead and record or watch the recordings or skip through it? Probably not. Probably not unless you actually get under audit, right? If you're confident that it takes 3.5 hours, you have multiple instances, but taking about that time, my advice would be put on your time log. Just know that in the back of your mind, you always have those recordings to back yourself up. Because let's be practical here. Are you really going to be able to sit there and watch and go back and record every single time? Is that really practical to do? I don't know. Maybe Brandon has a different opinion, but
yeah, I mean, so on my beach house, for example, I have Lockly, which is a smart lock. Now, I actually see somebody here ask the same questions. They asked about Schlage. But Lockly allows you to export, or actually, I don't know if it allows you to export. I just get a notification on my phone every time, and I've just been notating time in, time out for the Lockly locks.
And I assume you have a dedicated code for your cleaner, so you know it's not a guest, and that's an easy way, in my opinion. I think that's easier. For Schlage locks, Yale, Lockly, whatever, we all get those notifications, and there's a time log in the back end of the app that we can go in and reference.
Yeah.
And I assume, Thomas, you cover there's so many material participation. I don't want to take up the whole time on material participation. I assume you're covering that in the course, correct?
Yeah. So we're covering all of that in the course. I also have a running list of frequently asked questions that I'm probably going to add this to now, the lock thing, because the ring is definitely a way to do it. But if this lock thing works the way it works, then that's going to be the most probably easiest way to substantiate it, the most streamlined for you.
So here's what I'm going to take a second and tell everybody. We've got 62 people that are watching this. We'll probably have 300 or 400 of you that are going to watch this on the recording in the next 24 to 48 hours. Go up above, right here, right above this post. And yes, it's going to be recorded for those of you that have asked. Somebody asked if their course is applicable for a W-2. Yes. Go buy that course. Use STR Wealth. Save $50. It's $197. Use their tax benefit they shared with you. It's like $125. I'm going to personally give you a money back guarantee to where if you don't feel that you get at least $5,000 worth of value out of this course, I'll refund your money. Just shoot me a DM on Instagram. It's BillFaith73. It's that simple. That's how much I believe in what Thomas and Brandon are doing and how much I believe in their course. So I'm going to put my money where my mouth is. You guys go buy it. It'll literally be the best $197 you've spent probably this year. So I do want to move away because you guys have so much more to offer than just talking about material participation. And I know it's super important. I want to go back to my very first question, if we can, that I didn't get a chance to ask you guys. How does my setup affect my taxes? Is there a difference if I go and I buy as a second home in my personal name versus setting up in an LLC versus setting up in an S corp or a sub S corp? Or there's a huge new thing to where, shouldn't say new, but most attorneys are LPs, right? And now there's the Arizona LP that mitigates our liability. So I think we don't get a whole lot of information to where it's congruent from your guys' side on the tax side and then the attorney's side from a liability mitigation standpoint. What are your thoughts on that? I know it's a big question.
All right. Well, the first thing I just want to say is that if you because we get this question all the time, if you go to the bank and you get a second home loan or a vacation home loan, and that's what the bank is calling it, then that's all well and good. The tax code does not care that the bank is calling it a second home loan or a vacation home loan. To them, it's a loan. It's secured by the resident. It's secured by the residence. So what this means is basically that part doesn't matter. The interest can be tax deductible because you use the debt proceeds to buy a business property, right? So the debt's going to be tax deductible. the interest will be tax deductible, excuse me, and it's not going to preclude you from using the short-term rental loophole and using the strategies we just discussed today. So that's the first thing to note. The next thing is LLCs, right? So let's go through LLCs. So if you have a single member LLC, meaning you're a single owner, you buy a property, you put it in the LLC, right? You're the only member, you're the only person, right, in there. What's going to happen is that's going to be reported on your 1040 as if the LLC didn't exist really for tax purposes. So if you have it in a single member LLC, then you're going to be in good shape from a tax perspective there. There's no issues with it there. And, I can go a step further there. If you have the single member LLC, if you ever do provide substantial services on your short-term rentals, which are pretty much hotel-like services, daily cleaning, daily meals, tours, things of that nature, heavy amounts of recreational equipment, then you may be subject to self-employment tax. The self-employment tax can be mitigated with an S Corp election. So what you could do is you have the flexibility on the LLC to eventually make an S Corp election and pay yourself a salary and only pay the self-employment tax on the salary rather than the entire earnings of the company. And that's what the single member LLC gives you the flexibility to do, to make that S Corp election or not if you never need to. Whereas if you start off with an S Corp, that's not necessarily anything too detrimental per se, but then you have to file a tax return from day one. You have to do all these little compliance things. You have to file payroll for yourself. So you're adding all these administrative complexities and costs to an entity you may never even need. So I always suggest. Go ahead.
Yeah, I want to chime in there real quick too. So generally speaking, never put rentals into an S corporation. If there's that self-employment tax component, like Tom was mentioning, that's when you start looking at it. The easiest, simplest, and when I say easy and simple, that also means less costly thing to do is just to spin up an LLC and park your rentals in LLCs. LLCs precede LPs. Like there were limited partnerships and then LLCs were created because limited partnerships are too complex and cumbersome. So again, anytime that I hear LP, corporation, all I think is complexity. And then I think cost. And there are times and places to invest in that type of complexity. But it just kind of depends on how your portfolio is today and where you're trying to scale it in the future. So from a tax perspective, as long as these are all pass-through entities, it's typically not going to impact you on a day-to-day. But like I said, we don't want things in a corporation. We don't want rentals in a corporation because it does add complexity at later points of life that we would like to avoid now. It's very difficult to get rentals out of a corporation and restructure if you ever wanted to.
Yeah. Can I give a quick anecdotal story real quick? So here's the thing, right? If you put your rentals in an S corporation, you later need to remove a rental from an S corporation. That's going to be treated as a sale from the S corporation, even if you're selling it from an S corporation you own 100% to yourself or to another LLC that you own and control. It doesn't make a difference under the tax code. It's a sale, and that can cause a big taxable event. Had a client, obviously not going to mention any names, put a rental in an S corporation in the 90s because that was the thing to do in the 90s. The property appreciated significantly and would have had and trying to remove it for financing purposes because, long story short, the bank only wanted to lend to an entity that only owned that specific property for liability protection, right? And he had to remove it from the S corporation and would have incurred a very, very large six-figure tax bill from trying to remove it. So the point is you do not want to put rentals in an S corporation because, first of all, you generally don't need to. And second of all, if you need to restructure later on down the line, whether it be for financing or estate planning or whatever reason you need to restructure, you're going to be facing a very large you could be facing a very large tax bill, and it's very painful. And I've seen it happen multiple times. So just try to avoid S corporations for rental properties unless in very specific circumstances, which we're not going to probably go through. So just avoid it is the bottom line.
Awesome. Let's talk cost segregations for a few minutes. What are your guys' thoughts on cost segs? I mean, it seems to be probably one of the most highly utilized components for STRs to offset their tax burden. When should I do it? When can I do it? And what is the real benefit of a cost seg?
Well, I think you should do it almost every time. You should do it in the year that you acquire the property in general. If you miss it or you forget about it, or you've got properties that you didn't cost seg, you can retroactively cost seg. It's much more expensive from a CPA standpoint because we have to file extra forms and do a whole bunch of extra work for you, but it can still be beneficial and pay off. When should you do
say
it?
you do the cost seg in the year that you purchased the property, are you talking like the physical year or before you file your next tax return?
Yeah. So before you file the tax return for the year that you acquired the property in, so you can still today do cost segs for property that you acquired in 2021 if you haven't filed your returns yet. You haven't up until 10/15 of this year. That's when you're filing that tax return. Does that help?
Yeah. No, exactly. And I'm in this situation personally, just to tell everybody.
Yeah.
I literally delayed my cost segs because I wanted to get my taxes right for 2021, figure out when I was going to do it. I've delayed, 100% my fault. Other shit got in the way. And Yona's here. He's just said, great topic. I literally, I have to fill out his form when we get done because I have to get 2 cost segs done before I have to file my extension. Right. And now I'm up against the 8 ball to be able to get that done. Or I think those documents you said, if I didn't get it done, I'm going to have to file. I'm going to have to pay in. Then I'm going to have to pay you to come back and do a change of accounting afterwards. Right.
Yep.
So that could probably cost me a lot of cash flow in the short term, but also, I don't know, 5, 10, 15,000 bucks just to do a change of accounting.
And there's times to do it. So the timing question, the default answer is you should probably do it. But there's caveats, right? There's always caveats. The caveat would be like, I'm not a real estate professional or I'm not materially participating in 2022, but I expect to be a real estate professional or materially participate in 2023. So I wouldn't do a cost seg this year and put it on my 2022 tax returns, because if I did, the losses will be suspended passive losses because I'm not a real estate professional or I'm not materially participating, depending on what I'm cost segging. But next year, if I'm a real estate professional or if I'm materially participating in my short-term rentals, then I do the cost seg retroactively, but I apply it on my 2023 taxes, because when you do that change in accounting method, it hits that year that you're doing that change in. Or maybe I do this in 2024 or 2025. The point is that I would do it in a year that I'm not going to have these losses locked up and be passive. And that's not every time. Like I've done cost segs with clients and things like that, where it goes straight to the suspended passive losses. But it's because we know that next year or whatever, there's a strategy in place to liquidate some rentals, or we're going to see a lot of cash flow coming out of new rentals that we've stabilized. So we want these suspended passive losses already there to offset the future income, so we don't have to pay taxes next year on the income. So there's you got to work with an advisor to kind of figure out the timing piece. But like, if you're just super confused, I would still say in general, get it done. It's better, in my opinion, to have the suspended passive losses sitting on my return than have them locked into my real estate as not yet claimed depreciation. And the reason for that is inflation, right? So whenever somebody's like, well, cost seg's like so expensive and that doesn't make any sense if it's just gonna be suspended passive losses, and or it's so expensive and the net present value is just so complicated and these guys just market it all the time, blah, blah, blah. Okay, sure. But you would agree not to leave $200,000 sitting in a bank account today, right? I think everybody would agree with that. That makes total sense, because I'm only earning 1%, if that, on my bank account or my
What bank
deposit.
are you using? I need to switch my money to
1.4% at Ally.
Yeah, Ally Bank is where we park our cash. They typically have high yields, but 1%. But inflation's 9%. So I'm actually losing 8% every year on my cash that's sitting in my bank account. We all know that. That's like finance 101, right? But what we forget is that in my rental properties, I have predefined tax benefits, meaning that if Bill goes out and buys 10 rentals and he contacts me and he says, can you tell me what my tax benefits are over the lifetime of this rental? I could literally put it onto a spreadsheet and show Bill, here's the value of your tax benefits. And that just comes through depreciation, right? So I'm going to depreciate these properties over 27 and a half years or 39 years. and I'm going to get tax benefits through that depreciation. So
But
I
then
can
we're going to have
knock that
Yona
out.
accelerate that for us a little bit.
Exactly. Why would I leave $200,000 of tax benefits sitting in a rental? It's sitting in a bank account, because if I don't do a cost seg, and if I don't strip those tax benefits out today, then what I'm really doing is I'm leaving my tax benefits in a bank account that inflation is going to erode over time. Because if I do this cost seg 4 years from now, and then I get those tax benefits, well, I've already lost 4 years to inflation, because it's the same tax benefit dollar value wise. So what's really happening is I've lost it to inflation.
And those $5,000 couches, there's 2 of them. Those aren't going to last 27.5 years.
Yeah,
Right,
exactly.
right. Those are 5-year property eligible for bonus depreciation, so you'd be good in shape there.
Yeah,
exactly.
yeah.
Yona, get ready, buddy. We're going to accelerate these two.
Yeah.
So a couple of things. One, like in the strategies of when to and when not to do a cost seg, right? If I typically hold properties for 2-3 years and then sell and upgrade, what's the recapture going to look like? And I assume you consult with your clients on that, right? Because isn't it basically a 5-year recapture, and then it's going to be at your standard tax bracket for that year of your income tax or something along those lines? And then the second thing, go ahead and answer that. How does it get recaptured over that 5-year period and then after 5 years?
Yeah. So the 5-year property you're talking about. So there's different types of classifications of property. The 5-year property is known as tangible personal property. When you bonus depreciate that, and when you have to recapture it, it is taxed at your ordinary income tax rate. So that's part of the issue, right? That's why people will try. That's why people are scared of this. But the fact is, you can mitigate that. You can mitigate that by doing another cost segregation study on a new property at the time of the sale and wiping out the gain, including the recapture, at the time you sell that property. Or you can use a 1031 exchange and defer it that way. So the point is, you are going to face it at today. You're going to take the depreciation today, and then when you sell the property, that 5-year depreciation is going to be recaptured at your ordinary rates, but you can mitigate it. But the time value of money, like we're talking about here, is the real reason why you want to take it today. Because let's say you have $10,000, for example, right, that you got in tax savings from doing the cost seg study, or you can invest that $10,000 and over a 10-year period, for example, an 8% return, which is pretty conservative when you're dealing with rental properties. That's going to grow to around $15,000 or so. So, $25,000. So you're basically going to have $15,000 of wealth that you didn't have before if you didn't do this. So that's why you want to do it.
And Tom knows this really well because you're a CFP. Tell people what a CFP is.
Yeah, I'm a certified financial planner now, so I can give people.
This is right up his alley. But like to answer your question, Bill, in a more direct way, it would be, if you want to roll the depreciation recapture over into the next property, you can via a 1031 exchange. You can do what Tom said, buy another property, cost seg, get a big tax loss to offset the gain, including the depreciation recapture. But if you are just going to straight up sell a property and you're not going to, acquire something new, or you're not going to do a 1031, you will have depreciation recapture, because a cost segregation just accelerates depreciation. When we claim depreciation, our cost basis goes down, meaning that our eventual gain when we sell goes up. So you will have recapture, and it will be expensive. And that is when, like, if you're not planning on acquiring property over the next 5 to 10 years, like you don't want to be in acquisition mode for the next 5 to 10 years, that would be one of those questions on, how long are we going to hold this property, and should a cost seg happen? Because like Tom just mentioned, if I can get the tax benefits and reinvest those, great. The longer that I can reinvest those tax benefits, the more valuable the cost segregation study becomes. If I'm only giving it 2 years before I'm liquidating, and I'm not going to 1031, I'm not going to buy something else and get a big tax loss there, then maybe the cost seg doesn't make sense. But you can build all this out on a net on an Excel spreadsheet using net present value. So I mean, it's literally a formula approach that you can take to this, and it doesn't have to be theory. So
I usually start doing my tax planning the last week of October, and I historically have bought between 1 to 3 properties in the fourth quarter for this purpose. This year is going to be a little bit different because we start to sunset the cost seg benefits, right? And we're going to, on December 31st or January 1st, we're losing 25% value, correct? We're going from 100% down to 75% value next year?
100% down to 80%.
80%.
And 80% is next year. So you still got 100% through December 31st this year.
Okay. So how would that impact, and how long can we carry forward? Because I don't think people understand that they can, like you had mentioned earlier, you could take the cost save this year and have that sitting on your tax return. And I believe you can carry the benefit, if not utilized in a given year or next year, for 5 years. Is that correct?
Well, so yes. So if I only am able to claim 80%, then the remaining 20% I would claim over the remaining useful life of that asset. And that'll be a 5-year property, 7-year, 15-year property. So it just depends on which assets we're talking about in that. But honestly, like, I think dropping from 100 to 80%, yeah, you're going to lose a little bit, but I don't think that taxpayers are going to look at it as material. I think that, which just means I don't expect cost segs to slow down or become less valuable.
Right.
I do think that once we hit 60, 40, 20%, that's where people will start slowing down on the cost segs. But even if we had zero bonus depreciation, it's still a worthwhile tool because you're still accelerating depreciation for 5, 7, and 15 years versus claiming it all straight line over 27 and a half or 39 years.
Right. And I'm kind of looking at, if I lose that 20% on January 1st and I can carry forward 5 years, if I'm looking to make $1 million acquisition, I probably want to do it before this year, before December 1st, try to put it into service, or else I'm going to lose potentially $40,000 if I did it in January by losing that 20%.
Yeah, actually, yeah, pretty accurate. Yeah, a $40,000 write-off.
Correct.
Right. Which would translate to 12, 15, something like that in actual taxes between federal and state. So yeah.
What are some of the biggest mistakes you see us as investors, non-CPAs, non-financial planners making with our taxes? I mean, I think it really starts with our CPAs. Nothing against them, right? I mean, I've used my same CPA in Nashville, Tennessee for 11 years, and I love him. He's done great, but he doesn't know shit about material participation and cost segregations and, the short-term rental space. So I've used one of your guys' mentees, Ryan, to help me kind of, bridge that gap and communicate with him. What are the mistakes you're seeing those uneducated, I should say uninformed CPAs making, or us as investors?
I'll go first, Tom, and then you can jump in. I would say what I see in this, I'm a little bit more macro view. So Tom's a little bit more like in the trenches type of view, maybe. From my perspective, it's people that are not doing enough due diligence. They're hearing what they want to hear versus what they actually need to hear to make better decisions. As an example, we went through a period where we had a lot of leads coming to us, and they were all like, we're going to qualify as a real estate professional, but they all had full-time jobs, and we kept telling them, you're not going to qualify. And then they would get mad at us, and they would go and find another CPA that would sign off on that tax return. Unfortunately, those people are going to get audited, and they're going to lose. So what I always try to caution people, and I hold this belief true, close to my chest as I'm running my own business, you got to be really careful about confirmation bias. You got to be really careful about hearing what you want to hear, because this is not a place that you should be doing that. You need to be challenging opinions. You need to be asking questions. And that's the mistake that I see. And then it's just like, I don't know what questions to ask my CPA. That's the second issue, which is why we rolled out all that training that we did to help people kind of at scale. So,
yeah. I think kind of to that note, to that point, I think people go on online forums, people go on, people listen to what their friends are doing that aren't necessarily CPAs or tax advisors, and end up not really learning the full way things work. So they're picking up like these bits and pieces, like, oh, I heard it qualifies as a real estate professional if I spend 750 hours, but never quite get the other part of, oh, it needs to be more than half your total working time. So they're getting a lot of incomplete information off the internet. And kind of the next thing is they're also working with CPAs who aren't real estate specialists. And there's a lot of CPAs out there that are generalists. Like whenever I take a sales call, I ask a question to our potential clients. I say, hey, why are you looking to leave your current CPA? And it's because their CPAs either don't give them tax advice or don't have real estate expertise. So my suggestion is, if you're going to be a real estate investor, whether it's short-term rentals or something else, it's one of the most tax advantaged asset classes out there. And there's a lot of great tax benefits. And if you execute them correctly, well, then you could save a lot of money and protect yourself from audits. If you don't know about them because your CPAs don't tell you about them, or you get misinformation, whether it be from your CPA or from online forums, and you execute these strategies incorrectly, it's kind of like driving a car, but not having any idea how to drive. You can crash and end up costing you a lot of money. So my advice is, find a CPA, whether it's us or someone else like Orion or whatever, who understands the tax code, okay, and can give you advice and help you execute that advice properly, so you can not only save money in taxes, but you're protecting yourself the downside risk of an audit.
That's awesome advice. Look, you nailed it right at an hour, which is like amazing, like almost to the second. Thomas hit the number. Guys, I know there's going to be a million more questions. Those of you that are catching this on the broadcast, one last time, I don't want to seem pitchy. That's why I'm going to put my personal guarantee behind this. Jump on the link, spend the $197 with the STR Wealth $50 discount code. If you don't find, 5 times value in it, 10 times, $5,000 worth of value, just DM me and I'll give you your money back. That's how strong it is. That's how important it is. That's why they're here today. So that way they can educate you guys. They are givers, much as I am. Brandon and Thomas, I really appreciate you guys being here today for our group. It means the world to me, because I think this is such a as you guys alluded to, I think there's so much misinformation, and it's really kind of those half truths, right? And it's like Thomas, you said it perfectly. 750 hours is all I need to do, to qualify to become a real estate professional. It's much deeper than that. And folks, that's why you shouldn't believe everything on Facebook. A lot of us just got our degrees over COVID and Google. Make sure we do deep research and go to the experts. I really appreciate you guys. Thanks for being here. If there's anything I can do for you guys, let me know. And have a great day, everybody.
Thanks, Bill.
Thanks.